Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks to watch, economic news to follow. Stocks jumped on Friday despite a strong jobs report, initially worrying investors that the Fed would still have to raise rates one more time and keep them there for longer. The fact that those fears for higher rates may still come true and that only 3 of the 11 stock sectors closed higher last week leads me to believe that recent pullback may not be over just yet. That's why I went looking for the stocks that have been able to buck this recent downtrend, companies benefiting from those higher rates and outperforming the stock market. I'll highlight those safety sectors and stocks in this week's main topic. Stick around after that. We'll cover our Monday market update, stocks to watch, and the economic news that could guide this week. But first, one of the best opportunities right now is in the safety of CDs. That's why I'm parking some of my money in a no-penalty CD from CIT Bank. I earn 4.9% on my money. The bank is FDIC insured, so there is no risk, and I can cash out on any time. No penalties and no fees. There's no minimum to open an account, and you get daily compounded interest on your money. It's a great way to earn a high return on your cash while you wait for the stock market to settle down, or just to earn interest on your emergency savings. I'll leave a link in the description below. The bank also has e-checking, savings, and loans, so be sure to check that out. Back to our main topic though, because even after Friday's rally, stocks in the S&P 500 are still down 7% since the beginning of August, and if this week's CPI inflation report doesn't bring some good news, that pullback could return with a vengeance. And during this, the usual safety plays have failed miserably. Stocks in the consumer staples sector have fallen 12%, while those in the utilities sector are down 15% over the period. Those stable cash flows in these companies in these sectors haven't been enough to bring investors back versus rising yields in fixed income. But that doesn't mean there hasn't been anywhere to hide. We're seeing some very interesting parts of the market pop up as these new safety stocks in this era of higher for longer interest rates. Before we look into those sectors and stocks outperforming the market that are going to protect your portfolio with further losses, it's important to know why the rest of the market is falling. From there, we can see which stocks are being affected negatively and positively from this interest rate environment and invest for safety and returns. Now, why stocks are falling is pretty much obvious. The Federal Reserve has raised its benchmark interest rate at the fastest pace in 40 years and could still raise rates one more time to cool inflation. The rate on the 10-year Treasury reached almost 4.9% last week, its highest since 2007. So understand, higher interest rates hit company profits, stocks, and the economy in several different ways, with some stocks getting hit harder than others. Corporate America has grown fat and complacent over the years with almost a decade of near zero interest rates, basically borrowing as much money as possible to fund even the lowest margin projects. Companies with high amounts of debt are now going to see their interest expense jump as they refinance that debt over the next several years. So investors should look for those companies with cash flow positive companies and really a lot of times with lower amounts of debt. Many of the traditional safety sectors like real estate, utilities, and consumer staples are getting hit on the yield competition from bonds. With interest rates on bonds jumping higher, yield investors are selling out of their dividend stocks in these sectors in favor of just less risk in fixed income. These stock sectors will continue to feel the pain until the Fed confirms that it's done raising interest rates and moves closer to rate cuts. So then the stocks and sectors holding up against this recent pullback and the increase in interest rates are those benefiting from industry-specific tailwinds as well as those actually benefiting from higher interest rates. In that, insurance companies have been the standout with the iShares US Insurance ETF, ticker IAK, up 3.1% over the last 2 months. That is outperforming the broader market by more than 10% over that period. Healthcare has also held up relatively well with the healthcare sector SPDR, ticker XLV, down just 3% during that pullback. Within individual stocks and within insurers, United Health Group, ticker UNH, is up 3.6% during that pullback and is expected to beat its earnings when it reports this Friday. Like all insurance companies, UNH here is sitting on a mountain of cash that it needs to invest in ultra-safe assets that are ready to pay those claims. Up until last year, money market and the high credit corporate bonds paid next to nothing, but with that higher rate environment, that's changed into the insurer's favors. With even money market funds now paying near 5% interest, companies like UNH, these insurers, are seeing a huge jump in that interest income. And it's not just the health insurers winning in that high rate environment. P&C property and casualty insurers like Progressive Corporation, ticker PGR here, are also doing well. These shares are up 13% over the last 2 months. The company also reports its earnings this Friday with expectations for earnings per share to surge 248% just from the same quarter last year. Last year in the insurers, shares of Aflac Inc., ticker AFL, are up 5.7% in the last 2 months in that pullback, and the company is expected to report 27% rise in earnings when it reports on 1st of November. The company generally raises its dividend each year for that November payment as well, so that could help boost investor sentiment and put a little bit more cash in your pocket. Now, while shares of Walmart, ticker WMT, are down 2.2% over the past month, they are still outperforming that broader market in the pullback and should hold up well in a continued sell-off. The retailer is expected to report a 5% drop in earnings for the quarter versus last year, but generally beats its expectations, so I am expecting it to at least come in flat on year-over-year growth for those expectations, or for those earnings. Walmart has done well this year versus a lot of the other grocers and retailers by bringing shoppers in for those necessities like gas and groceries. So while shoppers kind of cut back on a lot of their other retail expenses, they have to come in to buy that gas and groceries, and they end up buying more than they expected when they get to the store. Costco Wholesale Corporation, ticker COST. This is an interesting one because this one's down just 0.6% over the pullback period and could report stronger sales from its recent marketing wins selling gold bars. The 1-ounce Lady Fortuna bars were a media sensation last week, selling out really quickly, and this is also going to benefit from bringing people in for those necessities, getting them into the stores to buy more than they expected. One of my favorite cash flow stocks here, energy stocks like Chevron Corporation, ticker CVX, dropped last week on that plunge in oil prices, but have held up really well over the past couple of months and should continue to cash flow. Chevron was down just 0.9% over the last 2 months on that strength in crude oil, but even with oil down here now at $82 a barrel, the company is strongly cash flow positive with a cost of production somewhere around $40, $45 a barrel. So it is still going to be able to continue to pay out that 3.7% dividend yield and grow its earnings over the future. And here, telecom stocks have been weak for the better part of the year as cash flows really failed to cover those dividends and debt payments. Seeing that in a lot of the companies in the group, including AT&T as well as Verizon. But the group has provided some safety recently in this pullback. I wouldn't count on telecom stocks for a long-term bet, but they can help investors hide out in this next month or two. Shares of T-Mobile US here, TMUS, they were down just 0.9% over the last 2 months, outperforming the market by more than 8% over that period. Looking at some of the stocks I'm watching this week, bank stocks start us off with the third quarter earnings season here on Friday and are expected to report strong earnings growth, mostly on the back of lower staffing and expenses, rather than really any strength in operations. Here we are on the SPDR S&P Bank ETF, ticker KBE, which really holds a lot of those banking stocks. More importantly, though, what I'm watching here is what the banks say about consumer credit and loan demand. It's going to help guide the market's perception of the economy and spending. So going to be some very important reports there from Citigroup, JP Morgan Chase, as well as Wells Fargo on Friday. AMC Entertainment, ticker AMC, is going to premiere its Taylor Swift Eras concert film in LA on Wednesday. The movie is going to be opening worldwide on Friday. And with that Actors Guild still on strike and just a few other big movie releases planned, this is sure to be the runaway with box office sales for the week. The concert has already booked a record $100 million in pre-sales, helped drive an 11% bump in the shares on Friday. That's why I bought 6,000 shares. I'm expecting a short squeeze on this one. It's one of the 4 catalysts I'm watching that could send this stock higher. Delta Airlines, ticker DAL, is also going to be reporting its earnings on Thursday. It's going to be one of the first airlines to really test the analyst expectations for this group to outperform over the next year. We saw in our market update last week a lot of the stocks analysts are watching the highest price targets versus where stocks are right now, and a lot of those are in those airlines. Analysts expecting some big things for the airlines this year. Delta is expected to report a 28% jump in its earnings on 13% sales growth for the quarter and to double its earnings per share this year. Leisure air travel is still very strong with that consumer spending, though business travel has yet to come back to those pre-pandemic levels. The recent drop in oil could signal lower costs ahead, though employee wages tied to a recent union contract settlement, especially with Delta, could weigh on those earnings. So I'm going to be watching this for clues into that resurgence, into that those returns expected for the airlines. Looking at the bigger picture here with the sectorspiders.com sector tracker, we can look here at the last week. Just 3 of the 11 stock sectors closed higher last week, painting a completely different picture than the one seen just looking at that 0.5% gain in the overall market on the S&P 500 there. The fact that the market's 2 largest sectors here, communication services and technology, rallied more than 2% each, It was the only savior that kept the market from closing sharply negative, really. So this broad weakness with most of the stock sectors down, along with a stronger than expected jobs report, kind of leads me to believe that that pullback is not over. It's going to be only the CPI inflation report later this week that can save investors from breaking back lower. Looking at the year-to-date picture, while the sector is still down 4.3% for the year, healthcare is emerging as a leader over the last few months. We can scroll out here to the 3 months, see that healthcare is outperforming over the 3 months, the 1 month, even over last week. Stocks here in the sector are valued attractively at 16.6 times on a price-to-earnings basis. We can see that here in the FactSet Earnings Insight sector level forward 12-month PE ratios. So this blue bar is this current PE ratio for the stocks in each sector. The green bar is the long-term average for those stocks. So a PE ratio, price to earnings, valuation ratio, which stocks are more expensive than their average. That is a little bit over the long-term average of 16.1 times, only slightly at a premium and very attractive versus a lot of these other sectors trading at steep premiums to their long-term averages. We can come back here to the sector tracker, expand this to see the individual stocks in the sector, and we can see that health insurers and drug makers are doing especially well, though hospitals and medical devices are still lagging. So definitely health insurers, drug makers within this. We could see a rebound in medical devices here pretty soon, but healthcare holding up very well against this market pullback. Thursday is going to be the big day this week with that CPI, the Consumer Price Index inflation report, expected to show inflation is slowing ever so slightly. Expectations are for the headline of 3.6%, core inflation at 4.1% to be just under last month's year-over-year numbers, 3.7% for the headline, 4.3% pace for the core. So we continue to see that pace of inflation in rents and housing costs are coming down slower. Now that is a third of the CPI report, that owner's equivalent rent that they measure to kind of measure how rent prices are going. It is a lagging measure, but a very important one, accounting for a third of the CPI report. So that's slowing in the owner's equivalent rent. Yes, rent prices, all prices are still going up, but they're going up at a slower pace. So they're not going up 9% year over year anymore. They're going up maybe 2 or 3 or 4%. That is important for the market, and that should start showing through in that larger CPI report. Okay, and it could be a surprise that brings that inflation down, a big relief for stocks if the Fed can stop raising interest rates and eventually start cutting it. I think that's going to help support stocks and in this pullback. Take advantage of that 4.9% interest rate in the no penalty CD from CIT Bank with the link below. It's FDIC insured and a great way to earn a return on your cash. Or click on the video to the right for the 7 high-yield dividend stocks that you can count on. Stocks with no dividend cuts. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.